Another 3 years. That's how long the Federal Reserve expects to keep its target interest rate close to zero. Chairman of the Federal Reserve, Ben Bernanke, has acknowledged the hurt such a strategy puts on savers.
My colleagues and I are very much aware that holders of interest-bearing assets, such as certificates of deposit, are receiving very low returns. But low interest rates also support the value of many other assets that Americans own, such as homes and businesses, large and small.
But low payouts from interest rate investments like bonds hasn't hurt the appetite for them. While investors have been pulling money out of stock funds this year, including $22 billion gone in August, bond funds continue attracting money, big money, $33 billion pouring into bond funds last month alone. But there is an upside to low interest rates, higher bond prices. One measure, the Lipper General Bond Fund Index, is up 6.3% this year, though that's less than half the gains of the Stock Income Fund Index that's made up of dividend-paying stocks. Tonight's Street Critique guest is Kathleen Gaffney, Portfolio Manager for the Loomis Sayles Bond Fund. She joins us from Boston. Kathleen, have dividend stocks replaced bonds for fixed income investors these days?
I don't think quite yet, although they're certainly looking pretty tempting. The problem is that there's a little more volatility in the equity market than there is in fixed income.
Do you think there's a lot more risk these days in fixed income with these low yields and higher prices compared to perhaps dividend stocks?
Well, the Fed has been very accommodative, as we've seen with QE3, and has much said that rates are going to be low for as long as we can see. That's a green light to look for yield, and we're seeing that in spades with voracious demand for fixed income securities that are yielding more than treasuries.
Yeah, so what's the environment like now for those bond investors today, those investors that are looking for a monthly income from bonds?
It's really challenging. If you're going to be looking for income, you're going to be taking more credit risk. Now, that's not necessarily a bad thing because it looks like the economy, the fundamentals are improving, not as quickly as everyone would like, but the economy is moving in the right direction. And the technicals are very, very strong from what we can see, that the flows are coming into corporate bond funds, and that's creating this huge appetite for the supply that we're seeing as well, because issuers are trying to take advantage of very low rates.
Yeah, a lot of companies want to borrow money at low rates, and some highlights of your bond fund really play this out. Your benchmark fund here has no government bond exposure. 22% of your bonds are junk rated, speculative, and a third are non-dollar denominated. In other words, are held in currencies other than the U.S. dollar. Is that how you're able to get that yield around 4%?
Yes, the below investment grade credits give us that yield. And again, the economy's improving, so we think it's a good time to be taking credit risk. And in terms of liquidity, that's what treasuries would normally fill that position. We're concerned about the long-term total returns in treasuries, so we're using Canadian government bonds as our liquidity reserve, with the added bonus that longer term, because the global economy should be doing better down the road, commodity currencies, Canada, Australia, and New Zealand will be doing better, so we like the currency there as well.
Again, Kathleen, I want to bring it back to interest rate versus bond price, because these capital gains we've seen with these bond funds have been great for investors. But again, for that need for a monthly income, how do you approach this market for the rest of the year?
It is a challenging market. When you look at the yield on corporate bonds, though, relative to treasuries, you've still got a decent pickup. Investment grade bonds are yielding around 3% or so, and on the high yield side, you're picking up 6%. Now that's skinny in terms of where they've been historically, but that's a good pickup for now, and I like that. I just wouldn't want to be spending new money on the new issues that we're seeing. One way to get the upside that you're seeing in the equity market is with our high yield exposure, we're using convertible bonds. So that gives us some of that upside.
All right, thinking creatively, a little bit out of the box when it comes to fixed income, looking for interest rate. It's our guest on Street Critique, Kathleen Gaffney of Loomis Sayles Bond Fund.